is the next in the series of videos concerning 4.3.2 factors influencing growth and development. Today we're going to look at the issue of capital flight. So what is capital flight? Capital flight describes a situation where investors lose confidence in an economy. This loss of confidence prompts investors to sell the assets that they own in the economy that they think hasn't got a future anymore. The domestic currency generated from the sale of the assets sold is then exchanged into another country's currency. So this might be Hong Kong dollars if you want to invest in Hong Kong. It could be Russian ruble if you wanted to invest in Russia, or maybe US dollars if you fancied US assets. Capital flight therefore causes the supply of the crisis hit currency to increase on forex markets. In turn, this leads to a rapid currency depreciation. For example, in 2009, the Icelandic krona suffered a 70% loss in its external value. This was largely due to capital flight out of the krona. People had lost confidence in Iceland. They didn't want to own Icelandic assets anymore, and they didn't want Icelandic currency. They wanted out. Capital flight can be caused by all sorts of things. In Iceland's case, it was a financial crisis that came about when the two largest banks in Iceland, Kaupthing and Icesave, I'm not kidding, collapsed. They'd made loans to people who couldn't pay back. In addition to a financial crisis, capital flight might be prompted by the fear of inflation. High rates of inflation, we'll see in a minute, can make domestic assets look less attractive to hold. So finally, what can we say here is that political factors can also cause capital flight. You know, for example, the election of a socialist government could cause panic. Owners of assets in the country with the socialist government might be fearful that the new government might use the power of the state to nationalise their assets without paying them proper compensation for the assets that they want. In the circumstances, the rational thing to do would be to sell your assets now before the state confiscates them from you. And if there's a feeling that this is going to happen, that could create capital flight. People sell before the event. They sell the asset, they get your currency, they don't want to reinvest it because they've lost confidence in that country. They want out. To get out, they sell your currency on foreign currency markets to buy another country's currency so that they can invest in another part of the world. And that essentially is what capital flight is. So let's look now at some of the causes of capital flight. High rates of inflation can cause capital flight from a country. International investors buy assets such as property, shares and bonds in different parts of the world. In general, international investors will invest wherever the rate of profit is highest. By owning assets, they hope to receive unearned income in the form of either profit, rents, dividends, or maybe even plain old interest. Investors prefer to buy assets that generate a high yield. The higher the yield, the more attractive the asset. If you look at the sidebar now, you'll see the formula for yield. Yield is the annual unearned income generated by an asset divided by the current market price of the asset in question. Yield can also be referred to as a rate of return. So let's take an example. Imagine that you're a rich Hong Konger and you own a London flat. The current market price of the flat is £800,000. If the flat was bought as an income generating asset, it could be rented out for maybe £2,000 a month, which would equate to an annual rental income of £24,000 per year. On the basis of these figures, the London flat would generate a 3% nominal rate of return, and the maths there would be 24,000 divided by 800,000 multiplied by 100. You can get your calculator out now and stop the video and just check my maths there. I'm sure it's right there. Now, this nominal rate of return of 3%, it might be attractive to an overseas investor if the rate of inflation in Britain was low, maybe 1%. Because an inflation rate of 1% would mean that a 3% nominal return would translate into a real rate of return of plus 2%. So at the time I'm making this video, there's a lot of money printing going on. So it's not beyond the imagination that the rate of inflation in Britain could accelerate quite nastily in the future. So let's suppose then that inflation gets up to 10%, which it was for a while when I was your age. So the combination of a 3% nominal yield and an inflation rate of 10% would not be good for an international investor, because it would translate into a negative yield of minus 7% per annum. A negative real rate of return of 7% would mean that the investor would be losing wealth in their London flat at a rate of 7% a year. Now, most people wouldn't put up with that. What would you do if you own a flat? The obvious answer is that you'd almost certainly sell up. Let's imagine that you managed to sell the flat for £800,000, so you've not lost any money. What are you going to do with the £800,000 that you get from selling the flat in London? Would you invest it back in Britain? You might do, but only if you can find, or you think you can find, a UK asset that's capable of generating a nominal yield of more than 7%. In all probability, you won't find that. So as a consequence, you'll want to take your money out of Britain so that you can buy an asset in another part of the world where inflation is lower, and hopefully you'll get a positive real rate of return rather than a negative real rate of return of 7%. If you do the smart thing and liquidate your sterling investment and take the money out of Britain, you'll have contributed to capital flight out of the UK. Again, I think it's going to be quite interesting to see whether there is capital flight out of Britain, given our government's performance over COVID-19 and whether we're able to get out of the lockdown and the economy is capable of recovering or not doing even worse than other countries, which is what's looking likely at the moment. The second cause of capital flight is economic uncertainty. Economic uncertainty happens when an international investor, or investors plural, lose confidence in an economy. And it could be due to all sorts of different factors. Maybe investors have lost confidence in the government and the central bank of the country concerned. They think, well, they just don't know what they're doing. Do I really want to own assets in a country that's looking like a basket case? Maybe the education system's lousy. You might think, well, no, I don't really want to hang around too much longer here. Better to sell now, liquidate the assets, get my money out of that country so I can invest somewhere that's got a better future. So if you're uncertain about an economy, maybe it's best to panic first, get your money out of there before you lose too much of it. So economic uncertainty can definitely create capital flight. It might be that you look at other economic indices. For example, in Britain, you might look at the huge pile of private debt that British households have racked up. Will UK households have much disposable income in the future to buy your products with? It's not looking like they will, especially as taxes will have to probably go up to pay for all the government spending that happened during the COVID outbreak. So again, it just maybe makes sense to, when the sky turns dark, just to get out, sell your assets with the cash that you generate, change it into another currency so that you can invest somewhere else. The third potential cause of a capital flight is just a perception that maybe a government might be on the verge of defaulting on its sovereign debt. A sovereign debt default happens when a government stops paying bondholders the interest that they're owed. Sovereign defaults typically happen during a recession. The recession causes the government's tax income to fall. As a result, the government doesn't have enough cash available to pay all of its creditors, including Mr. Bond. Rather than defaulting on internal creditors such as pensioners and public sector workers, the government might choose to default on its external creditors, people like Mr. Bond, banks and other financial institutions who bought government bonds as a fixed income investment. Bonds that go into default become worthless because they stop paying an income stream to the bondholder. Banks who held the bonds that have gone into default make losses as a result because they're not paying any income to the bondholder. Some banks might not even survive if they bought too many of these bonds that suddenly become worthless. This is why a sovereign debt crisis often leads to a private banking crisis. If you're 007, Mr. Bond, you own a lot of bonds in a country where the government's struggling to raise the taxes needed to pay you your bond interest, you don't want to be left with a bunch of worthless bonds that don't pay any interest. So maybe again, if there's any doubt at all that there could be a sovereign default in the future, you want to get out now. You want to front run that action. So what you're going to do, you're going to sell your bonds, you're going to get currency, and you're going to swap that currency out into something else, dollars, yen, Hong Kong dollars, whatever it is, and get the hell out of there. And that's how capital flight arises. Mr. Bond has a good think. Do I really want to be owning these bonds if they go into default? It's not looking good. Let's get out now. And once they've decided that, you then get capital flight. A speculative bubble is a situation where the market price of an asset grows at an accelerating rate over time. Speculative bubbles are caused by increases in market demand. Most of the people buying are speculators. They buy the asset now because they expect the price of the asset to keep on rising for the foreseeable future. The speculator's actions create a self-fulfilling prophecy. Speculative demand forces the price of the asset up. A positive feedback loop is then created. The initial price increase confirms the prophecy of rising prices. Due to herding, new speculators join the market, which adds to market demand, which causes new rounds of price increases. Speculative bubbles burst when the smart money in the market notices that the asset in question is now hopelessly overvalued, and they can normally tell that because the yield is very, very low. So at this point, the smart money sells, ideally before the bubble is about to burst. So if the smart money believes that there's a bubble and it could burst, that perception could actually lead to a wave of capital flight. So people sell up, hopefully before the bubble bursts and the price of the asset that they bought crashes. So again, it's this saying, if you're going to panic, panic first. So again, it's all about expectations of the future driving current decision making. If you're holding assets and you begin to suss out or realize that this asset is in a speculative bubble, you don't want to be around when that bubble bursts. So what you're going to do about it, you're going to sell now, and selling now creates that wave of capital flight. So let's look now at the possible effects of capital flight. We've looked at what can cause it. Now we're going to look at the effects of it. The first possible problem that a capital flight can cause is the emergence of a foreign currency gap. Foreign currency gaps are created when a country is unable to generate the financial and capital account surplus needed to pay for the current account deficit that they'd like to run. During a period of capital flight, investors are looking to sell assets in your country. They're not looking to buy them. Therefore, it will be extremely hard to run any sort of financial account surplus. As a result of that, you're going to suffer from a foreign currency gap. You're going to run short of the foreign currency needed to buy essential imports, because rather than investors purchasing assets in your country, they're selling them. There's currency outflows from the financial and capital account at a time when you desperately need currency inflows on the financial and capital account because you want to run a current account deficit. So one more time, if you're suffering from capital flight, you're going to be short of foreign currency, and that's going to cause some pain. You're going to maybe not be able to afford to buy petrol, medicines for hospitals, what else? Petrol, medicines, food, maybe you're overly dependent on imported food. So this again can be a real problem. So capital flight then, as evaluation, you would say that it's a really, really big problem for countries that run current account deficits. You can only run a current account deficit if you can attract enough inward investment to run the financial and capital account surplus that you need to balance off the current account deficit that you would like to run. And as I say, if you've got capital flight, you've got people selling assets in your country at a time when you need them to be buying those assets. The second problem of capital flight is that it can cause currency depreciation. Currency depreciation describes a situation where a floating exchange rate falls. So we've not really talked that much about exchange rates before, so let's get into this. An exchange rate is the price of one currency expressed in terms of another. Like any other price, exchange rates are determined by supply and demand. Let's take Iceland as an example. People buy Icelandic currency to purchase Icelandic exports, which is mostly tourism. Icelanders supply their currency when they need to buy other currencies. For example, a hotel in Iceland might have to supply krona in order to buy the euros needed to pay for German Beck's beer that they want to import and sell to their guests at the hotel. So foreign currency is supplied and it's demanded. The market comes into equilibrium at the exchange rate, the price, where supply equals demand. So the original exchange rate on the diagram is ER1, where S1 intersects with D, the red D. So let's say you've got capital flight. Maybe in Iceland's case, it was all about the two big banks going bust. So international investors got spooked out. They all headed for the exits at the same time. They all sold their Icelandic assets. They didn't want to use the krona that they gained from selling Icelandic assets to buy anything else in Iceland. They wanted out. And to get out, they went into the Forex markets and sold krona so that they could buy US dollars, euros, Japanese yen, etc. So the supply of Icelandic krona increased from S1 to S2, and that caused the exchange rate, the Icelandic krona, to depreciate from ER1 to ER2. And the diagram doesn't really do the depreciation justice, because the krona actually fell in value by 70%. Yep, a 70% depreciation of the Icelandic currency. Now, as you know, when an exchange rate falls, import prices rise. And that was a massive problem for ordinary Icelandic households, because a lot of the food that Icelanders eat, and stuff like wine, it's all imported. So a currency depreciation of 70% led to a 70% increase in the price of everything that was imported being sold in Iceland. So import prices soared. Iceland's CPI increased as a result of the cost push inflation generated by higher import prices, and those higher import prices were a product of capital flight that caused the currency to depreciate. So that high inflation created by the capital flight hurt Icelanders, because the inflation generated, the cost push imported inflation created, led to Icelanders suffering a very big drop in their real incomes. The final problem that capital flight could create is a credit crunch. In many developing countries, households are too poor to save. To obtain the loanable funds needed to operate, domestic banks located in these countries will need external finance from banks in other countries. During a period of capital flight, foreign banks probably won't be in the mood to extend new lines of credit to local domestic banks. In fact, the opposite is likely. Domestic banks, in all probability, will be asked to repay overseas loans. The end result is a domestic credit crunch, which is a sharp reduction in the availability of credit for firms that want to borrow to purchase capital, and for households that want to take out mortgages to buy houses, or take out loans to buy cars and other consumer durables. So, for this understandable reason, investment levels tend to fall in credit crunches. And as I say, those credit crunches can be brought on by capital flight. So local banks in poor countries get cut off from international financial markets, because those international foreign financiers have just lost confidence in that economy. They're not willing to lend to local banks anymore, probably because they don't think they're going to get their money back. So what they do instead is call in overdrafts, call in loans. And this is the capital flight phenomenon. Loanable funds are flowing out of the poor, crisis-hit country. That's what capital flight is. So that brings us to the end of our video on capital flight. Look at this cartoon. Outrageous. What is it suggesting? I wonder. Try to think of some reasons why there might be, at some point in the future, capital flight from the UK economy? Or would you rule that out as an impossibility? Have a think about it, make your own mind up. Before we go, I think it's also right for me to remind you of a link between this topic and herding, which was part of Theme 1, Behavioural Economics. Financial markets are prone to groupthink. Certain countries, certain asset classes tend to become fashionable, and investors will just follow the herd and invest in the same sort of assets that they can see other people investing in. Sometimes they might even know it's in the early stages of a bubble, and they're relying on what's called greater fool's theory. They know that maybe these assets aren't so great after all, but they know that these assets and this economy is fashionable at the moment. So if we buy now, we can take the ride up the escalator, and at some point before the bubble bursts, we can get out, hopefully before the rest of the herd turns and catches on to the fact that they've been buying assets in a bubble. So yeah, so that's herds can turn, and those turns can be quite dramatic, and they can happen very, very quickly. So a country like Britain, we run a big current account deficit. There's no problem at the moment. There's no foreign currency gap because we can easily attract the inward foreign investment needed to run the financial and capital account surplus. However, I would advise caution on hypothesizing that situation is a given for all time. It could well be that the situation changes. It's not impossible that there could be capital flight from the UK. Okay, let's move on to the last slide. So we're here already. Yes, in the words of Bugs Bunny, that's all, folks.